Good morning and welcome to TOITOI Japan Market Radio, December 12, 2025. I'm your host coming to you from Tokyo with a daily briefing designed specifically for global investors tracking Japanese markets. Today we're looking at some significant moves across equities, currency, and an emerging story around seismic activity that's commanding investor attention. Let me bring in our portfolio manager for the breakdown. What's the headline picture for Japan today?
Thanks. We're seeing broad strength across Japanese equities this session. The Nikkei 225 closed up 1.371% at 50,836.551, while the TOPIX advanced 1.929% to 3,593. The Mothers Index, representing growth and smaller cap names, gained 1.463% to 2080, and the J-Right Index added 1.079%, closing at 2013.5. On the currency side, dollar-yen is trading at 156.012, up 0.142%, so relatively stable. In commodities, gold priced in yen rose 1.371% to 15,900. While crude oil dipped modestly by 0.035% to 57.58. So the dominant theme here is risk on sentiment in Japanese equities, with defensive assets like gold also catching a bid.
That's a fairly constructive picture across the board. But I want to turn immediately to what's emerging as the top story today, and that's a major earthquake that struck Japan earlier. We're hearing reports of a 7.5 magnitude quake, which is obviously significant. Can you walk us through what happened and why this matters for investors monitoring Japan exposure?
Absolutely, and this is critical. A 7.5 magnitude earthquake hit Japan on December 12, and the initial analysis is focusing on potential economic and equity market ramifications. Why does this matter specifically for Japan? Well, Japan sits on the Pacific Ring of Fire, making it highly vulnerable to seismic events, and a quake of this magnitude can cause substantial infrastructure damage, disrupt supply chains, and temporarily constrain industrial production. Japan's economy is heavily reliant on manufacturing, particularly in semiconductors, automobiles, and electronics, so any disruption in key industrial zones can have ripple effects both domestically and globally. Additionally, reconstruction spending typically follows major earthquakes, which has both fiscal and inflation implications that the Bank of Japan will need to consider.
So we're talking about immediate disruption but also medium-term reconstruction dynamics. How should investors be thinking about the impact across asset classes, starting with equities?
For equities, we're likely to see near-term downside pressure on the Nikkei 225 and TOPIX. Manufacturing and export-sensitive stocks are particularly vulnerable given potential production halts or logistical bottlenecks. That said, there's a historical pattern here where insurance and construction sectors can see selective support as reconstruction expectations build. So it's not uniform across the market. Investors should be watching for damage assessments in key industrial zones, particularly around semiconductor fabs or auto production facilities, because those have global supply chain implications.
And on the currency side, we often see yen strength in risk-off scenarios. Is that the expectation here?
Correct. Historically, earthquakes and other domestic shocks in Japan tend to trigger safe haven demand for the yen. We could see yen strength as global investors reduce risk and repatriate capital. On top of that, if the Bank of Japan signals any policy accommodation or support measures in response to the earthquake, that could add further support to the yen in the near term. So dollar-yen could come under downward pressure from current levels at 156.012.
What about Japanese government bonds and yields?
JGB yields are likely to face downward pressure, meaning bond prices would rise. This is a classic flight to safety bid into Japanese government bonds. If the Bank of Japan also steps in with any accommodative messaging or extends curve control measures, that would reinforce the downward pressure on yields. So we'd expect the curve to flatten, particularly if the BOJ signals they're prepared to support the economy through this event.
Staying with the policy side, let's shift to another major story today, and that's market action ahead of an expected Bank of Japan rate hike decision. We saw the Nikkei jump 1.4% and the TOPIX actually hit a record close. What's driving this optimism despite the prospect of tighter monetary policy?
This is a really interesting dynamic. The strong equity performance ahead of an anticipated BOJ rate hike suggests the market has largely priced in the move and views it as manageable for corporate earnings. The fact that the TOPIX reached record levels is particularly notable because it signals broad-based strength across the domestic market, not just concentration in a handful of large-cap exporters. This matters for assessing whether the Bank of Japan can continue normalizing policy without derailing the equity recovery that's been supporting both consumer and corporate sentiment.
So the market is essentially saying, bring on the rate hike, we can handle it?
To a degree, yes. But there's a caveat here. The upside momentum we saw ahead of the announcement could reverse if the BOJ surprises on the hawkish side or if their forward guidance is more aggressive than expected. Exporters and financials tend to react differently to rate moves, so there's potential for volatility and sector rotation. Financials would typically benefit from a steeper yield curve, while highly leveraged exporters might face headwinds if borrowing costs rise meaningfully.
And what does this mean for the yen and yields in the context of a confirmed rate hike?
A BOJ rate hike would typically support the yen by widening the yield differential between Japan and other G10 currencies, particularly the US. So we'd watch for near-term yen strength if the hike is confirmed as expected. On the JGB side, expect upward pressure on yields, especially at intermediate maturities, as rate hike expectations get priced more aggressively. The 10-year yield could test key resistance levels, and that's something global fixed income investors need to monitor closely.
Meanwhile, in corporate news, there's an interesting divergence in today's trading. We're seeing reports that the Nikkei actually dropped 0.9% in another session with over 2,800 stocks declining, but at the same time Mitsui & Company, one of the major trading houses, soared 4.85%. What's going on here?
This is a classic example of market breadth telling a different story than the headline index. When you have 2,813 stocks declining, that's a signal of systemic weakness rather than healthy sector rotation. It suggests either macroeconomic headwinds, weaker than expected domestic demand, or perhaps external growth concerns weighing on sentiment. The outperformance of Mitsui is noteworthy because trading houses typically benefit from commodity price strength or improving emerging market growth. So some investors are clearly still positioning for commodity and cyclical exposure despite the broader market hesitation.
So is this a case of the market being in two minds about the outlook?
Exactly. The breadth of losses is more concerning than the 0.9% headline decline for the Nikkei. It suggests this isn't a healthy correction but rather broader risk-off sentiment. Investors need to monitor whether this extends further or if it's just a temporary pause. The strength in Mitsui and potentially other commodity-linked names suggests commodity markets remain supported, and that's worth watching. If that decoupling persists, it could indicate underlying resilience in cyclical sectors even as the broader market digests near-term uncertainty.
Shifting back to equities more broadly, how should global investors be thinking about the risk-reward here? We've got earthquake risks, potential BOJ tightening, and mixed market breadth all in play.
It's a complex picture. On one hand, Japanese equities have shown resilience and the TOPIX hitting record levels indicates structural strength. On the other hand, the earthquake introduces a near-term risk premium that's hard to quantify until we get damage assessments and clarity on supply chain impacts. For global investors, the key is to differentiate between cyclical volatility and structural disruption. If the earthquake damage is contained and reconstruction spending kicks in, that could actually support domestic demand over the medium term. But if key industrial zones are significantly impacted, that's a different scenario.
And on the policy front, how does the earthquake potentially change the calculus for the Bank of Japan?
That's the critical question. If the economic impact from the earthquake is material, it could delay or soften the pace of BOJ normalization. The Bank of Japan has historically shown willingness to adjust policy in response to domestic shocks. So while the market was pricing in a rate hike, That calculus could shift if the earthquake's economic toll is significant. Investors should be listening carefully to any BOJ commentary in the coming days for signals on whether they're prepared to look through the disruption or if they'll pause their tightening trajectory.
On the yen side, we talked about safe haven demand, but how does that interact with potential BOJ policy shifts?
It creates a bit of a tug of war. Safe haven flows would naturally support the yen, but if the BOJ signals they're delaying normalization or providing additional accommodation, that could cap yen's strength. Conversely, if the BOJ proceeds with tightening despite the earthquake, that would amplify yen's strength. So dollar-yen at 156.012 is sitting at an interesting level where the direction will largely depend on how the BOJ navigates this dual challenge of normalizing policy while responding to a natural disaster.
Let's bring this together for our global investor audience. What are the main themes to take away from today's session?